we're up almost 41% year to date on our public portfolio, and it's been incredible. I asked you guys on IG, what do you guys want to see? And it seems like most of you guys want me to talk about overall market conditions. Today, we're going to talk about the state of the economy. We'll talk about how we got these gains in this account. And more importantly, we'll talk about what I plan on doing in the future. Okay, so first things first, let's just talk a little bit about my account. This account is currently sitting at $112,000, which is amazing. We are up in a month 4.15% as compared to 2.39% on the S&P 500, and year to date we're up 41.33% as compared to the 16.68% on the S&P 500. And if you guys want to follow along with this portfolio's performance, make sure you guys subscribe to the channel because I'll be giving regular updates. And in this account, we're really just following the put selling strategies that we laid out in the masterclass that I'll link in the upper right hand corner. This is exactly how I go about making a lot of money through selling puts. Again, check that video out if you guys need more context. So with that being said, let's talk a little bit about market situations. And the first thing I want to touch on, the S&P 500 or the overall market as of Friday is now at all-time highs. Inflation reading came in lower than expected, and that pushed that market up, and it now broke and is at all-time highs. So there's a lot of optimism in the market. There's a lot of investments in AI, which is causing stock markets to go up. But at the flip side, there's also a lot of pessimism, softening labor markets, a lot of job losses, a lot of layoffs, and on the top of that, government shutdowns, which may or may not have ended by the time this video released. But there's a lot of uncertainty. The CNN fear gauge right now is apparently at the fear side. And obviously a caveat, I don't have a crystal ball. I have no idea what's going to happen tomorrow or what's going to happen a month from now. But this is just my read on the situation, how that's going to impact my investing and option selling choices going forward. Let's first talk about market valuations. One of my favorite metrics to gauge how expensive or how cheap a market is called the Shiller P. It looks at the price of the market divided by the average of the past 10 years of inflation-adjusted earnings. Unlike PE, it shows how expensive stocks are relative to their long-term earning power. If you look at the chart, Shiller's PE historically is around 16 to 17 times. Right now, it's at 39 to 40 times. That's more than almost double the long-term average. What this tells us is the market is extremely expensive and the market's already pricing in years of future growth. For me, when I'm trying to sell puts, right now is actually one of the hardest times to sell puts because we're trying to sell puts on stocks that are great companies but are fairly valued. Because we don't want to buy and acquire stocks that have no room left to grow. On top of that, there's another indicator called the Buffett Indicator, which is the total US stock market compared to the GDP. And right now it's at 220%. And Buffett himself will say that this is extremely expensive, right? But what's causing these valuations to be high? Valuation being high isn't necessarily a bad thing if the market can actually hit those valuations. We saw with NVIDIA early this year where valuations were extremely high, but NVIDIA kept hitting every single earnings mark and their stock continued to go up. So let's talk a little bit about why these valuations are high. S&P 500, like I said, was at all-time highs and is mainly powered by the AI boom. We've partaken in this rise up. If you look at our portfolio holdings, you can see ASML is up 42%, NVIDIA is up 32%. We sold a lot of puts on NVIDIA, and our TSMC shares that were assigned from our puts are up 61%. So we've ridden this wave up. Most companies that are leading in the AI boom are listed on the American Stock Exchange and are American companies. Think of NVIDIA, Google, Microsoft. Right? A lot of foreign capital, a lot of capital is pushing these stocks up because they don't want to miss on it. That's not to say that the boom won't continue. But because it's boomed for so long, there could be a potential that the valuations aren't hit. So let me show you what I mean by that. If you look closer at individual stocks and their valuations, so as an example, AMD's trailing PE is at 151 and its forward PE is 50, which means that as of right now, if you buy one share of AMD, you are paying $151 for earnings as of today, and you're paying $50 for $1 of earnings 1 year from now. So AMD has to either double or triple their earnings to hit Wall Street's expectations. That is extremely hard to do. And if AMD, for example, doesn't hit that metric, their stock will probably regress and fall. And that is true for a lot of other stocks. NVIDIA is sitting at 35 times PE, and that's extremely high for a company that is the largest market cap in the world. Microsoft is at 31, Apple is like 28 or so, and these companies are expensive, right? because investors are assuming that there's going to be insane revenue and growth and profit growth for the next year, benefiting from AI. They are phenomenal businesses, don't get me wrong. We have NVIDIA, we have TSMC, but they are priced for perfection. The S&P 500 right now is extremely concentrated at the top. I saw this one table. It showed that the Mag 7, the Magnificent 7, which is like Microsoft, NVIDIA, Meta, Amazon, Google, and Tesla, they make up around 33 to 35% of the S&P 500. That is higher than back at the height of the dot-com bubble in terms of concentration. That just shows you that these ultra blue chip, ultra mega caps have grown a lot in valuations. The mid cap, the small caps have not grown. So this tells me one of two things. One, there's either a buying opportunity in these smaller and mid caps. So you can see me selling more puts on companies like NVIDIA, on IoT, right? Or that the ultra big caps are overvalued and the market will regress to the norm. And the scary part is, if any one of these 7 or all 7 were to fail to hit that lofty expectation that we talked about earlier, the S&P 500 will drop. And if it drops, that can potentially impact every other stock in the S&P 500 because there's correlation. And that could impact our public portfolio and your portfolio as well. Let's talk about macroeconomics for a little bit. Inflation is still high. It's at 3%. So we feel that each and every day when we go out and shop, right? Cost of living has increased pretty dramatically. There is now a softening in the labor market. There's a lot more job cuts and layoffs. There's also a lot less hiring, a lot less job openings. What that also causes is causes the Fed to drop interest rates, right? To try and stimulate the economy. However, they're kind of stuck between a rock and a hard place. Inflation is still high with a weakening labor market, which means that if they were to reduce their interest rates, the Fed fund rate, they're potentially increasing the money supply that can push inflation further up, right? Interest rates usually are raised to lower inflation, but that also has an impact on the labor market because it's harder to borrow money, it's harder to stimulate growth, which then leads to a softening in the labor market, right? You can see how they're diametrically opposed to each other. So the Fed right now is trying to figure out what's the best course of policy. And the worst case scenario is if they're not able to maintain control, right? You can go into a recession, even worse, maybe stagflation. So for me, when I read this, I go, there's a lot of uncertainty in the market. It's probably harder to trade than it was 5 to 10 months ago when the labor market was still strong and inflation was coming down. And the Fed could just keep interest rates high because they're not forced to lower interest rates, right? It makes things a lot less volatile, a lot less uncertain, therefore a lot easier to trade. So there is pros and cons, as you can clearly tell from this video, right? Pros in the market with AI, pushing valuations up, with a lot of foreign investment coming in because they want to partake in the AI boom. But on the flip side, there is a lot of macroeconomic situations or fiscal policy that causes uncertainty in the market. On top of that, high valuations mean there's less room for error. So the way I read it now is after a 41% growth in our public portfolio, that there's a lot less upside and there's a lot more downside. So what does that do with our plan going forward? Overall, what that means for this account is we are not going to try and make much more money. We're going to try and protect our gains. I don't want to lose the 41% that we made. So I'm not going to try and optimize for profit. What that means is, one, we're going to be selling a lot less puts. We're going to keep a lot more money in cash for the possibility that the market may drop. And like we said in the Put Selling Masterclass, again, I'll link in the upper right-hand corner, when market drops, VIX spikes. And when VIX spikes, it's good for us because we sell options at a higher premium. And two, stock valuations drop, therefore we buy stocks at a better price, right? Right now, prices aren't right for us to sell puts, so we don't want to overstretch ourselves. We won't do that. Number two, when we're selling puts, you'll see a lot less yield on the puts. We're trying to, I told you to target 1.5 to 2.5%. I might drop it down to 1.25, 1%. I'm not trying to overreach, right? Because again, I don't need that money. I'm not trying to make too much money. Number three, on the flip side, I'm trying to find value in this market. I'm trying to find stocks that I believe in 10 years from now at a fairly good value. So you'll see a lot more stocks in the small to mid cap market. You already see it with IoT, a company that I really, really like. And you'll see it with NVIDIA. Because the risk is so high that I need better reward for the risk. Go by these mid-cap companies or small-cap companies have much higher upside. And so these plays become much more valuable to me because I can make potentially more money with the same downside risk as a potentially selling it on a stock like Tesla. And lastly, I might plan on hedging, right? I know there's a put selling only account, so I might sell some calls, maybe. But again, I don't want to really sell it on my TSM because I believe in it 20 years down the line. And honestly, TSMC's valuation is pretty good compared to everybody else's in the semiconductor market. And two, if I were to hedge, I would actually buy a very far out of the money leap, a put option to protect myself to capture some of the downside if the stock market were to reverse. All right, so that's about it. Let me know down in the comment section below if you guys like content like this. I think it's very fun to make because it's kind of like predicting a crystal ball that we have no idea what's going to happen. On top of that, it is what I think about when I sell and manage my portfolio. Again, let me know down in the comment section below if you guys want me to add or do less of these commentary. Hopefully it was helpful. And if you guys like content like this, make sure you guys like and subscribe to the channel. It will really help me out because I'm trying to provide the best content for you guys. So yeah, you can also learn how to retire early like I did. And to all the members that have joined my community, you guys are amazing. Thank you so much. That means the world to me that you guys are even supporting my channel. If you guys want to learn more about my put selling strategy, I'll link it in the end screen here. And two, if you guys want to learn more about my credit spread strategies, which is my predominant way of trading short-term volatility, I love that strategy. Check out this video in the end screen here as well. And like always, stay safe in the market. Until next time, peace.